Welcome to the Real Advisor Podcast. TRAP. Trap. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the Trap team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of Trap.
Yes, indeed, dear Trappers. Welcome back to what many people are calling episode 86 of the Real Advisor Podcast, TRAP, Trap. My name is Lick Lincoln, and joining me as ever in the digital studio of doom are the three other horsemen of the apocalypse. Carl, the voice, Delavocci Widger, Andy, Ultra Heart, Alan, the storyteller Smith, and a guest fifth special member of the Trap Pack, the one and only Mr. Pete Matthew from a place called Cornwall, I believe it's pronounced. Is it Cornwall? Pete, welcome to Trap.
Well done. Thank you. Thanks for having me, boys. It's great to be here.
It's great to see you.
Thanks for coming along, Pete.
Thank you.
I don't think we need to do any introduction for Pete, do we? Everyone knows. Who doesn't know Pete? The King knows Pete Matthew.
World famous Pete.
I don't think the King knows me, but maybe yet.
Father.
Right.
Thank you very much. Very kind.
Let's get this bloody show on the road. Mr. Andrew Ursane Hart, my right honourable friend, would you read out some more high energy review reads, please, for episode 86?
Sure, I will do that. I'm a bit all over the place because my computer has broken, some of my backup computer. So here we go. The first review is from Andy Waldron, 5 stars on Apple. Must listen for all advisors. Having been in the industry for 20 years, it offers loads of insights and wisdom, often not found elsewhere. A really invaluable source of knowledge for new and experienced advisors alike. I also did leave a review for my own show just to nudge us up the ratings, but I won't read that one out today.
I thought you were. I was going, is he actually going to read out his own review?
Nah. Just always be closing, boys. The final review is on Podcast Addict. No title, because for some reason they don't do it. Anyway, been listening since episode 1. I'm not in the finance game, but love the podcast. I'm an index fund investor who has an interest in the financial world. And sorry, Carl, but I want to retire early, brackets fire, as I want to be able to affect change in the world and not have to rely on a payslip or doing things I don't want to do. Andy, you're responsible for a lot of my education about buying the great companies of the world. Then I found out you stole all of your knowledge from Nick. I'm assuming that's Nick Murray. Alan's stories rule. Thank you.
Back to you, Nicholas.
Thank you.
There you go.
Just on that, he's saying that he's all for financial independence, retire early, and because he wants to do stuff and wants to impact the world. So my problem with FIRE is like this whole just retire early and do nothing. It's like, what's your purpose afterwards?
Yeah,
so that guy is actually doing exactly what I have always proposed the FIRE movement should focus a little bit.
Excellent stuff.
Thank you for the review.
Good. Interesting as well that you can actually leave text reviews on Podcast Addict, not just the star review. That's interesting. Okay, let's put a timestamp on episode 86 with guest Trap Packer Matthew Pete Matthew. It's interchangeable. Episode 86, let's get things underway. So obviously the budget's been and gone in this country, and we were all looking forward to it. I think we had about 3 years notice, and one of the recurring themes was this thing about tax-free cash, being reduced and pushed down. I think Torsten Bell, who's the UK advisor to Rachel Reeves, was just advocating pushing down to something like 40k was one of his plans. Anyway, I came across this article which came out in October from Tom McPhail, and you can spell McPhail any way you want once you've heard this. Tom McPhail worked for Hargreaves Lansdown for years. He's a real pensions guru, down in the weeds with pensions, highly respected within the sort of industrial side of this thing of ours. And he put this article out in October, well in advance of the budget, saying he'd taken his tax-free cash. And it's just like, okay, I give up. I absolutely give up. If the experts, he is a peak knack, right? He knows everything about pensions, except how to take them properly. He acted in fear, took the tax-free cash out of his pension. He's just wondering again how many people were influenced by him. And when you read his article, he makes a rationale for it. He says, "I'm taking the money out and I can put it into ISAs over a number of years. So in the end, it'll be tax-free." Blah 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 blah. Yeah, okay, great. But now it's in your estate. If you happen to die, Tom, I'm not advocating for that. But if you and your wife happen to die in the next year and a bit, that money is now liable to inheritance tax. I don't know. It's just you know, as we come on to in the meat and potatoes, our lessons of the year, I shall refer back to this story, but it just struck me as, you know, there they go. Thoughts?
I think people like certainty, and at least he's taking control of his own circumstances. What I didn't read the article, but what he hasn't said, because I've certainly taken some of my tax-free cash on the basis that if you're at the maximum allowance, tax-free cash allowance,
he was way over it, Alan. That's what
he was way over it, right?
Yeah.
Okay, so
he's got some merit in it.
He can't grow the tax-free portion any further, and I know that the rules may change in the future, but there is some merit, I believe, in taking control of your own destiny and not being at the whims of current or future governments. And I think that's an underlying theme for a lot of people, a lot of our clients as well.
He took a gamble that Rachel Reeves could quite easily have cut the ISA allowance, you know, but therefore he couldn't have funded his ISA at the rate that he wanted to with the tax-free cash to keep it tax-free.
He dealt the cards which were currently being played to him, and I think what we know is this is never black and white, and a lot of personal and emotional and circumstances play into it. So, you know, I think he's all right. Tom, he's at Lancat now, isn't he? Yeah.
Yeah, he had a podcast, didn't he? But that's like they often do. That's kind of withered on the vine, and he hasn't done anything for a year. Well, no, they do. You don't notice them until they're gone, because your app doesn't suddenly pop up and say, "Did you realise this podcast has evaporated?" And then you sort of think, "What happened to Tom McPhail's Landcat podcast?" And it was over a year ago that he'd asked for something out via that brand, if he's still connected with them. But, okay, all right. That storyteller.
By the way, just as I get started, for those who are not watching but are listening, I'm the only one present who's showing some Christmas cheer by wearing a festive Christmas hat. Lincoln McScrooge, his contribution to the festivities is wearing a cap with the word "no" on it, which kind of, I think, probably summarizes all you need to know about Nick Lincoln, particularly at this time of year of goodwill to all men. No. And by the way, this is I'm shoehorning this in. This is my lucky hat, because it was the very hat that I wore only a few days ago when representing the Real Advisor podcast. I won the Christmas quiz, the mellow Christmas.
So if you're representing the Real Advisor podcast, clearly we won.
We won, yeah. And so we are now a multi-award-winning podcast, not just an award-winning podcast. You're welcome, boys. You're welcome. Anyway, this is
Thank you so much, Alan. It means
I
so
did wonder
much.
what you were going to say when you said that was your lucky hat. That's the hat you get lucky in, is it?
Fingers crossed, Pete. Fingers crossed.
It's that time of year.
It is that time of year.
You're missing a B at the end, Nick.
Pardon?
Nothing. All right, on we go.
Your hat. It was a joke. Your hat. Your NO was missing another letter. My
Doesn't work at any multiple levels. Can we get on with this?
My topical tidbits. Again, I don't know. This stuff comes up. It's a bit repetitive, but the Financial Times carried an article a few days ago, which was all about UK pension funds, and I emphasise the word pension funds, who are now taking a view that the US stock market is overheated and therefore selling down significant parts of their US equity portfolios, and it goes into the detail of, you know, Schroders with 200 billion and this fund with 100 billion and other ones. You know, they were talking about hundreds of billions of money involved in this, and you know, this is a kind of this cuts across whether what you think about it or not. Efficient market hypothesis suggests that the current prices are the sum total of all participants in the market. That is how prices are discovered. Everyone agrees what a price should be. So every single participant in the market arrives at NVIDIA's share price today. And in an hour, it's something different. And next week, it's something different. So what effectively UK or a significant part of the UK pension fund investment management section are saying is that we know better than the combined wisdom of all the other participants in the marketplace. And the thing that I find this just odd, while they're taking taking a view on this, is that these are pension funds. So these are, and thousands, hundreds of thousands, if not millions of people. So these are likely to be multi-decade, at least, investment mandates. These are going to be going for 10, 20, 50 years hence. And they come up with all the various things about, we feel the market's overheated. It's time to, to take risk off. An interesting one from, I think it's the Nest one, which we mentioned before. They said, we're going to move out and we're going to allocate more funds to private markets in order to de-risk, which again is when we've talked about this before, because the CEO of that company has got strong views on private markets. Anyway, I just found it a bit odd that all these huge institutional investors effectively are saying we know more than everyone else combined. Interesting article. Any thoughts?
It's like an oxymoron. We're going to de-risk by putting more money into the private markets.
Yeah.
Seriously,
Yeah.
Come on, lads.
That's been a recurring theme of Trap this year, this private markets thing, isn't it? It's just,
Yeah.
it's the train coming down the tracks, and we're kind of saying, Jesus Christ, stop that train, and it's just getting bigger and bigger. Okay, staying with you, storyteller.
Yeah, this was just, this time of year, we have all the various, I think a lot of YouTube do it now, a lot of companies.
Replays,
replay or rap, Spotify rap, which is, it summarizes, for those of you who don't know, if you subscribe to things like Spotify, it gives you a list this time of year of how you've spent your time listening and or watching. And we saw it was, somebody contacted me, I'm just looking it up now, about their, how many minutes they had spent. You guys got this. And it was just quite extraordinary, the amount of time that people have spent listening to Trap throughout the year. So I initially thought we'd found a head and shoulders above everyone else winner in terms of listening time, who it was friend of the podcast, someone that helps us out at live events, helped you out this year, Andy, whose name is Rue, who's at First Wealth, who had listened via her Spotify app to 5,808 minutes of Trap this year alone, which is almost 97 hours of listening to Trap this year, which I thought was just hard to beat.
Mother of God.
But listen,
but there's more.
Listen to this if I can find it. But then, guy, over in your part of the world, Mr. Widger, gentleman by the name of Mark Westlake comes in and beat even that. His figure is 8,205 minutes of listening to Trap this year alone. He spent a lot of time catching up. 8,000. How many hours is that? It's a lot. 8,205 minutes. I said we'd give him a special prize, give both of them a prize at Trap Live next year. But that is dedication to the cause, isn't it? That amount of time listening to our ramblings.
Just to not leave our guest out, Rue sent me her top 3 podcasts of the year, and Meaningful Money was number 3, Pete. So,
Hey, I'll take that.
You're still in the mix.
Still hanging in there.
Yeah, just about hanging in.
Yeah, he feels under threat for sure.
Yeah, for sure. Everybody's doing these rap things, though. I had one from Monzo just as I was walking up here from one office to the other, and there's like a little coffee shop kiosk thing just outside my studio, and apparently I'm the 14th biggest spender in Cornwall at that place.
According to Monzo.
That's because he spent £8.50.
That's true, Andy. Yeah, exactly. Oh, no, I'm a bit of an addict.
Pete, how many episodes have you recorded now of Meaningful Money? What are you up to now?
620, I think we're on.
Wow. 620 episodes. Magnificent. Magnificent.
That excludes hanging by a thread.
Yeah. We'll never get to 100 because
Pete, that excludes your YouTube.
Oh yeah, there's nearly 800 videos on there. Yeah,
sure.
Yeah.
It's
dogged determination. It's because I like it.
But it's brilliant. Brilliant.
Keep at it, mate. One day it might be
highly
success.
recommend everyone tunes in if they haven't done it. But I'm sure they have.
Appreciate that, but
Good stuff. Okay, so happens again and again and again, and just when you think things are getting better, you realise that there's still a swamp out there. I had a prospect meeting this week with a prospective client. You can call them prospects. You don't get shot. It's a good thing to have prospects, otherwise your business is dying, as Mr. Matthew might allude to in his meat and potato section. I had this prospect. He's in a low-risk, cautious fund, not set up by me, set up by an advisor, and he's in this AJ Bell cautious fund. Now, all 5 of us, I think, see risk as being the erosion of purchasing power by inflation. Everything we do is trying to mitigate against the 3 to 4 decade cancerous effect of inflation on the real value of our clients' money. That's real risk. Real risk is running out of money in retirement. But of course, this client, this prospect with another advisor, must have gone through the mumbo jumbo questionnaire, answered questions he didn't really understand, and just gave them back and was too embarrassed to ask or clarify, and end up in a cautious fund, on the AJ Bell platform. And the 5-year annualized return of this cautious fund is 2.75% per annum. UK inflation over that period, it comes in at 4.9%. So you have a 5-year locked-in, total, long-lasting, permanent loss of purchasing power. The most risky thing that someone coming into retirement, as this prospect is, can possibly do. Once again, I think we look through the world through one end of a telescope, and a large part of the advice community has the telescope turned around the other way. And maybe never the twain shall meet, but it's out there, folks. It's never going to go away. There.
No.
Horrendous kind of story.
APC, all perfectly compliant. Horrendous real-life client outcomes, but all perfectly compliant.
I mean, this is the thing that you couldn't, if they had complained and done a proper complaint, ombudsman letter, all that stuff, it would not be upheld. It would say this is a fully compliant file. You've been absolutely financially screwed.
Furthermore, Alan, I would say that the manager, the fund manager of the cautious fund, is quite pleased with 2.75%.
Yeah.
It's in line with expectations.
Remitter did. Yeah.
You know?
Yeah.
So there you go.
Probably beating some inane benchmark.
Honestly, I think this is the one thing that winds me up more than most on this. And I know people like to have a go at things like it's apparently easy targets like St. James's Place and others. This does far more damage in our industry than any other. Almost the worst of it. These kind of direct sales outfits or big institutional firms. This sort of stuff, which is basically built into the fabric of, and I call it an industry of risk profiling, tick box advice, and just following the process. And I mean, you wouldn't mention Nick, but the firm are, they're probably following what their compliance officers told them. If the clients
the client would have got an 85-page suitability letter that was just.
It would have said the word "you're a cautious investor," and they'd have quietly nodded. Well, yeah, I guess I am. I'm coming up to retirement.
Really cautious. Right.
Yeah,
I am quite. Obviously, when I saw these figures and when I was talking with the client, I was kind of inside of me. I was dying. But I don't want to. I don't know who the advice firm is yet, and I don't want to badmouth them in front of the client. I mean, obviously, I'm going to suggest. I think the advice I'm going to give you is far more appropriate because it's done right.
Yeah.
And secondly, the client's going to feel a bit foolish.
Just move on. But
move on.
But just
save them from the darkness.
Yeah.
Right. Talk moving on. Let's move on. Ultra's first point of episode 86.
Nick, let's stay on this point. So now this client has been through a full ATR, full suitability, cautious portfolio. You're going to come along now and put them in the right portfolio, but you're taking a professional risk. You're going to increase the allocation to global equities, where the returns come from. But you understand the professional risk you're taking.
Yeah,
so in hindsight, 5 years down the line, this gets looked at. It says, why on earth have you done this when clearly the client was cautious? I know this is the professional risk that we're all taking on these clients and re-educating them about proper risk. But yeah, this is what real advisors deal with. All right.
I guess isn't that the power of the financial plan. So, you're really talking to the financial plan at that point. You're trying to take it away from the whole premise of the meeting now is about the long-term goals for the client and taking it away from the investment discussion for a little bit before you bring the investment discussion back on the table. And then you're talking about why this is much more appropriate. Because do you remember when we showed you the long-term financial plan? And we know what money you need in the next couple of years, and clearly we'll have accounted for all of that. But I think that's really important because if you go to you're in the wrong fund, and here's a better fund, without really spending a lot of time going through your financial plan, I think then you're going to be in a little bit of trouble.
Just come back to Pete in a sec. Sorry, Nick. I'm assuming no financial planning has been done. There's been no
financial planning has been done.
Of course. Yeah. Standard.
No financial planning has been done. Absolutely.
I was going to say, absolutely. There's a professional risk. You just know if if markets tank or whatever, it's going to get questions. But you can do the right thing, APC as well, all perfectly compliant. And then Nick hopefully is as protected, surely, as the previous advisor. But at least it's a better outcome. Do you know what I mean? I think APC can work both ways.
Yeah,
I think that's right. But it definitely demands a level of extra arse covering. From your viewpoint, Nick, I know that you've said this, but the reason why this is not appropriate is that we saw something the other day in another group, didn't we, Andy, Nick, about somebody, if I remember correctly, had a global equity portfolio, a typical kind of balanced, diversified portfolio, but there was like 8% in emerging markets.
Emerging markets, yeah.
And that was considered, that's high risk, therefore all the advice is wrong.
That's right, yeah. Foz said it was too high risk. It's like nuts. It's part of a balanced, diversified portfolio.
But you shouldn't have anything in emerging markets, despite the fact that it represents whatever it does as a percent of global equities. It's just a fundamental misunderstanding.
To sort of, I'm quickly lower my hand just to prove I can do it and then lower it again. To quickly just nail this down and come on to Pete's point. Well, it's protocol, Pete. You've got his things.
Yeah, I know.
When I go through this client, the next meeting is the presentation back of their financial plan. Okay, and we're going to do the cash flow, and I'm going to show him that based on his current fund and where he is going to run, and this client is going to run out of money in all likelihood before he runs out of life. Okay, and I'm going to say to him, okay, we can stop this. You've got to invest this way. If at that point he still says no, I'm low risk and I want my low risk returns, I won't engage him as a client. Just don't let the loons on the bus is the best way to also APC. Get the vetting process down. And don't let them on. You've only got so many seats on your bus. These people are going to be with you 24/7 for the next decade, 2 decades, however long you want to remain as an advisor. Weed the weirdos out and do it early doors. So right. Yeah. Okay, now I'm going to move on. Ultra, your first point.
Yeah, my first point is I came across this the other day. I don't know if anyone else has come across it on the call. Maybe Pete. Aviva Save. Now, this falls into the, let's call it, cash management area. And I know we've touched upon cash management in the past, and I've always been reluctant. A lot of them are sort of new players, unknown brands, and God forbid someone's low-risk cash element, life savings, get run into some serious trouble. So Aviva have got this thing called Aviva Save, and they're pitching it as like, we're a very famous brand, and you've got one login, and then effectively you could set up like 10 different cash accounts with 10 different providers. In the old rules, it was 85,000, and my second point is the FSCS levies increased from 85,000 to 120,000 on the 1st of December. I know some people on the call would have probably missed that, but that again is big news for people that are shifting money across savings accounts. So I come across it, Aviva Save, and it's quite good tech. You just, as I say, you have one login, you can click around and move all the money around, and it saves you doing all the heavy admin.
So it's a bit like those other aggregators. It's a bit like that.
Well, a client I'm taking on is using it at the moment, and when they sent me the breakdown of their cash accounts, I thought, Jesus Christ, where is all this stuff? And then they said, oh, by the way, it's just wrapped up in this thing called Aviva Save. And then I checked it out.
Right, so there's all these underlying accounts with whatever.
Underlying accounts,
society, banks.
Hargreaves do it as well.
Transact
do a form of it. Hargreaves are quite active in this space. I can't remember what their offering's called. But
Active Cash.
For Aviva, Active Cash, yeah. So Aviva to get involved in it, I think, is an interesting step. Aviva are huge. They're our biggest insurance provider, investment manager. I know L&G are close to them. It's if people are a bit more cautious using random unknown company cash management, I think they'll be a lot more comfortable in using someone like Aviva. So I thought it would be worth mentioning. And that's it. And the FSCS levy's gone up from 85 to 120 on the 1st of December.
The protection level, not the levy.
The protection level, yes.
My levy's not going up to 120 grand.
Well, give it time, Pete. Give it enough time.
Not yet. I was going to say, you wish it was, mate. It means the business is
well, I suppose
flying. Anyway. Back to you,
Woj, give us the latest dose of what's going on over the Irish Sea.
I had to put. I'm just gonna unload them all, get all the bad news out.
Get it out of the way.
There's lots of stuff happening here on a couple of funds that I've mentioned before. So all three of the articles that I've shared are all from the Business Post, and I do have to say to the Business Post in Ireland, fair play. They're doing some proper financial journalism, and they're reporting stuff that should be reported, because sometimes this stuff is kind of swept under the carpet. So Solar 21 that we've spoken about before, facing a couple of winding up petitions. There's some questions around fundraising fees. Imagine that. Basically commissions, loans to other group companies, and unexplained project activities. And there's also a 9.2 million transaction to a connected company that one of the founders owns. So that's all seems to be coming to a head over the next while. So look, I do hope that there's a lot of investors in these. So we do have to think about those poor sods. who are waiting and waiting and waiting for the outcomes. It does look like these things will be coming to a head early in 2026. Arena Capital liquidators have been appointed there, and the best case scenario, it seems from reading a couple of different articles on this, is that people will get 20% back of their investment, but it could be as low as 11%. But there was also in Arena Capital an intercompany loan of 17.6 million, and the court said that the three directors, may be on the hook for that loan. So I think shit getting real in those two scenarios. There is another fund then in Ireland called the Green Man Fund. It's a German property fund. It mainly does Lidl's and Aldi's and that kind of stuff. And it's massive. And a lot of financial advisors in Ireland have sold the Green Man funds. There's one, depending on where you read, it's either 1.2 or 1.4 billion of investor money in Ireland has gone into this fund. And there are 8,000 Irish investors, right? So this is very, very significant. Now, there's no suggestion that the Green Man Fund is in bother in terms of the assets. However, they've run out of road in liquidity, it seems, because there's been an awful lot of redemption requests. So they're gating the fund indefinitely. And the managing director in the interview said that the best case scenario would be 12 months, but it could run to 18 months before people will get their money back. So, look, whilst the first two, the firms themselves, it seems, are going pear-shaped, the Green Man Fund is, look, just another lesson that investing too much of your clients' money in these property funds, even if they're open-ended and they change to an open-ended type of arrangement, the small print can catch you. And if, for whatever reason, I think Aviva took the Green Man Fund off their platform or something like that. We don't have any exposure to it, so I'm not really sure about the detail, but there was some news that triggered a lot of advisors going, take the money out. There was too much redemption. Obviously, they're invested in German commercial property, so they had to go, whoa, stop, everybody. So you just wonder what the future holds for Green Man. There's an awful lot of investors. It'll be very well-known product via the financial advisory community here. So obviously not good news for people who are looking or needing their money back now. They have to sit and wait and hope that the values hold up for the 18-month period.
Interesting that Irish advisors are so well versed in the German commercial property market. Storyteller.
It does strike me a little bit that Ireland is kind of going, you're a few years behind what the UK has gone through. Because remember, this sort of thing used to be quite not uncommon, shall we say? Yeah. Going back maybe 5 years.
Longer than that, surely.
No, but I mean, it has been going on forever. But then
5 years was COVID, man.
Yeah,
all right. Time before that.
But maybe 7, 8 years. I'm just trying to.
Well, also, how far behind property funds go back to the life funds. That's the early 2000s.
Yeah, but all right, we had all the key data, the Arch crew, and what have you. But then we had like the London Capital mini bonds. There was a spate of these things for a while, and I mean, I'm sure they're still going on, but they're not anything like with the frequency of the occurrence that they are now. So maybe it's just, unfortunately, it's a kind of process. Eventually they get washed out of the system, because I never hear any sort of reputable advisor recommending any of these things nowadays. Whereas I guess in Ireland, there's quite a lot of, I would imagine, reputable firms who've recommended the Green Property Fund, for example, quite decent.
Well, the Green Man one would be known as very professionally run.
Yeah, I'm sure it is. But then there's this liquidity issue and gating and all this is another. We've been through all that.
And look, like you would say, for example, if any of us on this call were recommending a commercial property fund like this, we would make sure that that's okay if there was a gating scenario, that we have other liquidity there.
Yeah.
But there's 8,000 investors in there. I can tell you, not all of those people have financial plans. So I just hope that there's nobody that, looking to retire now and they've, I've all my money locked up in the Green Man Fund. And that's where the problems do arise. And that's where people are going to have problems. The other two scenarios are just, they were
they're just scams.
Yeah.
The sounds of
Well,
It's quite high averages, Carl. I did 1.25 billion, 8,000. It's 156,000 euros on average. It's quite high averages. Some people will have their full life savings in it, is what I'm getting at.
God.
That's kind of my point. That's my point.
156.
Yeah, and look at it. Like, I think in terms of the returns, it has done exactly what it had promised to do.
They always do property funds. They just go like that until they
very
don't.
good. It's not very good net yields and all that. But see, net yields are pretty much irrelevant when now they have to go and obviously sell some assets because it's not the net yield is deriving your return. Now it's right. Well, how good.
By the way, so this is
the Aldi store outside Stuttgart. How much are you going to get for that?
Exactly.
Who knows?
But this goes back to Nick's earlier point and like risk management. So liquidity risk? It's a massive risk. You just get a run on the bank, as is happening here. This could be, in theory, this could be gated for 5 years. For example, they're going to start unwinding property portfolios and very illiquid assets when everyone else is trying to sell at the same time. It's going to impact the value, and it's a vicious circle.
Yeah, and also, I suppose one of the challenges in this kind of a scenario, the reason I know, but this is what happened in the financial crisis here, right? We were all in geared property funds, right, including me, right? So, not saying that I didn't make those mistakes, because when you have to sell, and the market knows you have to sell, you ain't going to get the current market value. You're going to get a lot less than that.
Yeah. They're rubbing their hands. Yeah.
I just want to make a brief additional point, and if you like, if in any way in defence of people who invested, I was in a prospective client meeting this morning, and this is the guy who's about to sell it, and there's big numbers, big ticket numbers that were involved, and he said his opening thing is, by the way. He said, I watched that Madoff film over the weekend, the Bernie Madoff. He said, I said, oh, why'd you watch? He said, no, a friend of mine, my mate knows I'm about to get quite a big, liquidity event. Just have a look at this. And he said, and it's not unreasonable, he said, how do I know that you're not one of them? How do they know? How does it? Madoff was a, highly legitimate, authorized SEC or whatever it's called, broker advisor. And you can't blame investors for just thinking, well,
correct.
This looks legit. This seems the guy who I met is a lovely guy. Blah blah blah. Blah whatever. And I thought it was not an unreasonable point the guy made to me this morning.
This is a real point, Alan. It really is. And we've just done some content that Sinead Clinton, our head of compliance, has done. Just a couple of videos about the journey your money goes on, where it goes, and all that kind of stuff. And we did it because we were challenged exactly like that by, well, this all looks kind of okay, but what if?
Yeah.
So it's, I think there's an education piece there and getting some, creating a document around the security of your assets. That's what we actually entitled it. And then they did a couple of videos behind it. So I think that you can help yourself by actually, haven't we spoken about this a lot, Alan, before, about the corporate governance and compliance, making it actually a USP and actually taking it so seriously that you're giving people a little bit more security, a little bit more assurance that this is all as it should be. That's all you can do, really.
Okay, Good stuff. Bernie Madoff, Jesus. Some of the stuff.
Yeah.
I mean, it's still
movie,
to me.
though. Great
good film.
Yeah. Just unbelievable. Well, I read the book. I was just looking up there. No One Would Listen by Harry Markopoulos, who was telling the SEC for years, these figures cannot be true. Markopoulos is kind of a bit on the spectrum, just a number person. He could look at numbers and see patterns and just look through. And he said, Madoff, he cannot, this split strike conversion strategy, he called it. He said to the SEC, he said he cannot be delivering these returns of 1% to 2% every month in, month out, year after. It is statistically impossible, and they wouldn't listen. So younger advisors who maybe even Bernie Madoff's just a name, right? It's and how that guy put his head on the pillow at night and slept. I do not know. That is sociopathic behaviour way out there. And the film's brilliant. It's brilliant in an awful way. He's dead. His wife's dead. I think at least one of his sons committed suicide. It's just a tragedy for everybody involved. Awful. Okay, now I just confused you, Pete. I bumped you up the list to get your voice in the show, so you're next.
Thank you. I need to be more proactive, clearly. Yeah, this was so this is Martin Lewis, right? So Martin Lewis, arguably the best known financial commentator in the UK. Love him or loathe him. I feel like advisors kind of want to not like him, but he's doubtless done a lot of good over the years. However, Right, we're going to qualify that because I don't watch his show. He's got a show. I don't know if it's on ITV or whatever or BBC,
ITV,
but their little snippet came across my YouTube feed while I was in the bath on Saturday night. That's what I always do when I'm in the bath. I watch YouTube on my phone, right? Just
real rock and roll stuff.
I tell you what. yeah.
I'm in the bath watching personal finance podcasts.
Yes. Try not to linger on the mental image, right? It'll do you no good. Okay. So for Martin Lewis has studiously avoided talking about investing in the true sense for pretty much his entire career. And then for some reason, completely out of the blue, he did a segment in this show about essentially index investing.
Proper
investing and the returns that it can deliver. Now, it wasn't perfect. One of the slides he put up showed sort of discrete year-on-year returns of like the S&P and the FTSE 250 or whatever, and he joined them. So it looked like a line chart when actually he was just saying, this is the position in, 2015 and then 2016, 17 or whatever. And if if in 1 year it does 10% up and the next year it does 2%, well, if you join those two sort of points together, it looks as if it's gone down from 10 to 2, whereas, of course, it hasn't. It's gone up 10% in 1 year and then up 2% in the following. So I thought that was really lazy and pretty rubbish producing, whoever sort of signed that off. But then he put this slide up that said, had you put like £10,000 in the Martin Lewis best deposit account for the last 10 years, you'd have, I think it was 10,000, you'd have something like 12,750 or something like that. I should have written these numbers down, really. But he did say, however, inflation would have meant that you would have needed, in order to beat inflation, you would have needed sort of, 14 or whatever. So he actually said, the very best deposit returns would have underperformed inflation. And then he brought in FTSE 250, S&P, Brilliant. And all that. And it was just like, I can't really believe he's saying this after so long. And it was actually, I think, an overwhelmingly positive thing, despite my annoyance about the chart before. Fellow YouTuber Tony Newbat did a pretty good sort of summary and response to it, actually, fairly quick. But I just thought it was a really good thing, and I feel like it's sort of the universe will revolve around the point at which Martin Lewis started talking sense about investment.
Yeah.
So I was glad to see it, put it that way.
Yeah, I did watch it. I watched it on catch up. I think it was about 13 minutes long. I think it's absolutely superb. He was very nervous and apprehensive to do it because he's an expert in saving money, not making money and investing. It is rather ironic. Obviously, people that follow him are just trying to save, £4 on their electricity bill and £3 on their mobile bill. And had they invested this money many, many years ago, they'll be loaded and they wouldn't have to worry too much about saving money. But it is really good for full fat financial advisors. It is going to do great work for us. Proper global equity investing. He hammered it home that it will be volatile, but inflation is your big problem. I thought it was brilliant, absolutely amazing. I think it's gone down really well with the rest of the financial planning community. Alan,
I don't know. Maybe I haven't seen it, but maybe it has done. It sounds like it was good. Apparently, he got absolutely slated for it. I saw on Martin. I saw on Twitter.
No, what I saw was generally positive.
I saw him on Twitter on Friday afternoon. He said, right, I'm off all social media for the weekend. This I can't take. He said, it wasn't an area of expertise for me. Did my best. I can't take the abuse. See you all next week kind of thing, which I thought was interesting.
It's not like the UK LinkedIn community.
Is that LinkedIn or X?
Oh, an X. That's it, Twitter.
X.
X. So that's maybe probably explains it.
Doesn't make a difference.
But the other thing that strikes me is the other sort of so-called famous financial commentator is Paul Lewis, isn't it? And because you mentioned active cash earlier on, how is he able to continually stand by this thing? All his own private money, his SIP and everything else is in cash, and he moves it around every 6 months or something. And he still goes on about it to this day and stands by it.
Well, I'd raised my hand actually to bring Paul Lewis into this conversation because Paul Lewis and Martin Lewis, who are not related as far as I know, they're just obviously there's something in the gene if your surname's spelled Lewis. Paul Lewis, he doesn't reference inflation. If he does, I haven't known him do it in the last 15, 20 years. It's all about nominal returns. And he just ignores this elephant in the room. And at least Martin Lewis has tried to bring it into the conversation. I can't believe he got attacked that viciously for it. And I can't believe he's thin-skinned. So maybe he did get attacked that viciously and felt the need to come on social media. But that's really odd all round. But yeah, good. Someone out there, someone in the fifth estate is talking about the real danger. And I wish more would do it.
Yeah.
Okay, we now are going on to Ultra. Our friend, whose piss frequently boils. Excuse me, listeners, but that's his phrase.
That's an in-joke.
That's an in-joke. Okay, Keith Button, who runs Boost, is a fellow... is a Trappist, has come to Trap Live, so he mentioned, sent me a link to his latest financial planning masterclass that's happening in 2026. It's been pitched for early stages, and he's got 100 tickets, online tickets for this event. First one is starting on January the 31st. There's a link in the so-called show notes. I know quite a lot of people have been on it before. He gives a lot away to the rest of the financial planning community. He's very outspoken. I spent a week with him in South Africa. Lots of fun. So yeah, check out the link to the link in on LinkedIn.
Good stuff.
That's it, really.
Well done, Keith. Okay, so Andy mentioned this phrase. I might be misphrasing you here, Andy, so Ultra said just correct me, but you get these hand grenade questions from clients. You're happily working at your desk, you're doing this and that, and suddenly you get an email from a client. And it kind of lands in your inbox, and it's like, and the client just taps it away, doesn't think much of it. So I had this email today from a client, I think it's about 45 words. It begins, my total earnings, including just announced bonus, confirmed as 262 grand. I also received $100,000 in long-term incentives. We have the option to pay some of all of our bonus into our pension on a salary sacrifice basis. I was thinking 20 grand. Does that seem sensible to you? End of his question. And to unpack that, it's just... So luckily now we do have things like AI, which I am using. And I could put that question to air because underneath that, you should know this client is receiving a 10% employer contribution already and 3% personal contribution. And it's not a scheme that I administer. So, I haven't got to hand straight away what his unused allowances are from previous years because it's not a pension that I manage. So it means writing to the, anyway, I put it into Grok and Gemini because I check now. I tend to use two AI models and they both came back with the same answer. But thank God firstly for AI because it was a bloody convoluted answer. And the answer was no, you can't put any more money into your pension with those figures. It's not, he's a 45% taxpayer now. He'll get a 45% tax charge if he does so. I can't think of a good reason to do it. But thank God for AI, one-man band on my own. I don't have a technical team around me. Just this time 2 years ago, it had taken me the best part of, I don't know, God knows how long and how many downloaded spreadsheets from providers to work out the tapered annual allowance, all that crud. But a really loaded question. And I went back to him and said, much as I love salary sacrifice, as much as we want to buy now while stocks last, because of what happened in the budget, I would advise you not to. So just got the hand raised. Ultra. I'd
still triple check that elsewhere, Nick, but it's probably good news for you that the answer's no. If the answer was maybe, and if you need to do this, that, and the other, your Christmas would have been ruined.
But I think this is the point I was going to make. I'm going to reference this to Andy Hart and call it the car park question. Because remember you said this is like a client. This is a typical scenario, and we get them all the time. Clients park their car in the car park, walk in to get on the train. They literally walk into the train and they go,
send you one WhatsApp that's ruined your day.
And suddenly they think about something or they're reading the news and they send you a little, it takes them literally 30 seconds to send it. And then a day of your life is gone just for that.
That's why email should be charged at 1 penny an email. It would cut email traffic, honestly, by 98% across the world. Just a penny. Is it worth a penny?
And then you go, no, I'll leave it. I'll forget it. I'll work it out.
I love that idea.
Me too.
Yeah, I love that. Yeah, for sure.
Okay.
Where would you go, though? Who would get the money? Who would get the money?
The tax man, obviously.
Wow.
But Nick, what's going to happen when that client doesn't ask you and just goes straight to Gemini or ChatGPT and says, actually, you know what? I don't need Nick anymore.
I think you'll still come back to Nick for confirmation.
I don't mind AI doing I don't mind AI doing data crunch and stuff. information's everywhere. Wisdom is sold separately.
Is it all
That's just
all the
accounting rules and
touchy-feely stuff
taxation.
that you focus on, Nick? All
Yeah, the touchy-feely stuff, embracing the clients, listening to them, being empathetic,
give them a
seeing the
hug.
world through their eyes.
Yeah.
I haven't got any of that, and I can still make it work. So it's fine. Okay, moving on. Oh, Christ, Ultra, make this interesting.
I can't really make this interesting. It's, personal finance and tax. It's a combination of a disaster, really. So it's this whole movement by the revenue making tax digital. Now, this would have affected all of us on the call, UK individuals that run limited companies. It just means you've got to use accountancy software to submit your numbers to the revenue on a bit more of a frequent basis. Anyway, there's a change coming in April 2026. And it's impacting property investors and sole traders. And it basically requires, if they hit a certain limit, to have tax reporting software, and you've got to report your earnings on a quarterly basis. So, for example, let's say someone has got rental income of £51,000. At the beginning of next tax year, they need to report this quarterly to the revenue. So it's going to be a big change for portfolio landlords that currently do everything at the last minute. And also, if you're a sole trader, let's say you, run a beauty business and make £60,000 a year, and you did everything at the end of the year. Now you're going to have to change. And they're saying something like, I can't remember what it is. It's like 2/3 of sole traders still do things on pen and paper. So they're just getting along with their day, keeping receipts, putting them in a shoebox, giving it to the accountant at the end of the year. And now it's like, no, you need to use accountancy software. You need to take photos of everything. So there's going to be a huge change for a lot of sole traders that are caught up by this, and also property investors. And they're starting off with quite a high limit, then bringing it down. And they think what they're going to do is start with the high limit, bring it down, and then also make them pay tax quarterly, which could be a good thing in the end. So I'm a bit on the fence of, is this a good or a bad thing? But it will be affecting a lot of our clients, that's for sure. Any questions? No, great.
Carl.
Yeah, good try making that interesting. Well done. Good effort.
Can't polish a turd. Watch.
The latest Central Bank of Ireland report is out.
Woohoo!
Where's the clappy sound, Nick?
We're 39.5 billion richer than we were last quarter. And this is Irish household wealth, right? So this is actual families. So on the surface, that's like, wow, that's amazing. But I read the report. The report's actually, the Central Bank are doing some really good stuff in terms of really well put together reports that are really easy to read as well. So I looked at this and I'm like, wow, this is magnificent, because we were already clearly loaded and now we're even more loaded. But of the 39.5 billion, funny, half of it is in household property assets. And we as a nation had to just revalue all of our properties for the local property tax. So it was like, all you scamps out there had undervalued your properties. So now all the properties are properly valued. So that was one thing. But the other half was almost entirely on deposits.
Wow.
So like when you look, they set out the graphs. There's this tiny 0.4 of a billion is gone into equities and investment funds. And then all the rest of it is gone into deposits. So the deposits, I've spoken about it before, it's just going up and up and up. But look, from my point of view, if you're in our world, in Ireland at the moment, the opportunity is actually endless. Like, we have never been in a better place to go and find all of these families, to do long-term financial plans, and explain to them, a little bit like what you were talking about earlier on, explain to them about the wealth that we can create for ourselves. And this is like multi-generational wealth then for these families that can be passed on if you actually do the right thing with your money and not just be saying, I'll just stick it on deposit. And along with that, the Irish banks here, and hopefully there'll be new competition in 2026 coming in, but the deposit rates are pitiful. They really are. So I read these reports and I kind of go, wow, we're reducing tax on investments, right? It was stupidly high. We're reducing it with a commitment to reduce it even further. You're allowed to put, in 2028 or 2029, you'll be allowed to put 2.8 million which is actually really 2.95 million into a PRSA. There, I got PRSA and I haven't mentioned it in a while. But everything is actually helping us here.
PRSA Corner.
But in summary, we're getting wealthier, but our work is not even close to starting, I would say. We have such opportunity to do really great work to then create wealth for our families ourselves without having to rely on the state and what might come out in finance acts or finance bills and all that kind of stuff. So look, just interesting, but well done the central bank for churning this stuff out because it's keeping us informed.
That last point you make, Carl, about the amount of money held in cash deposits, lower returns, and what have you. Again, there's a similar theme coming here. Our regulator here, the FCA, put out a report last week, I think it was, and to their credit, I think they are beginning to open their eyes to this thing about risk and volatility and what have you. There's a lot of data they refer to. And it says their report, just quoting from it, 61% of adults with £10,000 or more in investable assets hold all or most of their investments in cash. So 61% of the market, they've got a bit of money. It's pretty much all in cash. And they are trying to go through the report. And
that was before the Martin Lewis show last week,
that was before, yeah. That's going to be completely different now. But there does seem to be, an element of, we try to explain this to customers and to average people who've got a bit of savings that may be holding it all in cash, because they do refer to risk as one of the risks being inflation risk. So at least it's a step in the right direction, I think.
Someone on X did say if you wanted an indicator for surely we've hit a market top is when Martin Lewis is talking about investments on the TV to the mass public. It's like, do you know what? You got a good point there.
Yeah. Okay. Good stuff. So, who is now? Pedro.
Yeah, this was in the FT weekend before last, I think. We know for sort of 18 months, 2 years, the successive chancellors have been trying to boost the economy by making us invest more of our pension funds in UK stocks.
They go on much longer than you'd imagine.
Yeah, they do, don't they? When you're waiting to come back in afterwards. Yeah.
I'm trying to fade these out as well. I'm conscious of that. Sorry.
Yeah, that's right. So, that's been happening for 18 months, 2 years, whatever. Started with Jeremy Hunt, and obviously the Mansion House Accord was earlier on this year. And yeah, there was a thing in the FT report that the MP's own pension scheme
outrageous
holds only, I think, 3.3% allocation to the UK, which is lower than the average pension fund in the UK at large. So, I just have a fundamental issue with career civil servants telling me how I should invest my own money in the same way as
correct.
I have issues with them telling me how to, how to run a business, having never done so themselves or whatever. And I just thought this was testament to the just nonsense of it all and how broken really the system is, and just made me go, makes sense.
Yeah.
Sod you all.
Well said, that man. I could, without this being a complete love, and I could complete this of all the things that make me have a Keith Button moment with my, this is just, as you so say, what it's nothing to do with politicians where pension funds invest their money. Okay, their pension fund trustees have a duty to maximise returns for the pension fund unit holders within agreed parameters of risk and so forth. And for politicians to suddenly, that's a nice little pension fund you've got over there. It'd be a shame if something happened to it. This kind of inference that we're going to, take away some of the tax breaks the pension funds get if you don't direct it more to the UK. That's bad enough. But for these people in Westminster, these politicians, for their own bloody pension fund itself to be less than the UK global cap weighting.
Yeah.
Most UK-based funds are generally, double 10%, 11%, 12%.
Essentially, yeah.
They're at just over 3%. It's just the hypocrisy absolutely rankles with me. And
and me.
Yeah. Anything else to add, boys?
No.
No, okay, well raised, Pete. Okay, on to the final thing. Oh, yeah, so we talked about LinkedIn last week or last episode 85 of the award-winning Real Advisor podcast on my daily trip to the orphanage in Mumbai, and that's how I read LinkedIn. So I did change my feed. It was on recent, and you're right. Sometime in the distant past, it got switched back to top stories. I changed it to recent, and the feed is still beyond awful. LinkedIn is still a place of absolute doom and misery, and that's all I want to say on that. Right. We're at 54 minutes in. I think it's time we moved on to what many people call the meat and potatoes of episode 86. This is where we take a weighty subject and give it a damn good thrashing. And the weighty subject today is, what have we learned from the last year? This is the opposite time of year to do this. Spotify is sending out their yearly summaries. YouTube's doing the same. Let's have a yearly summary of what we have learned over the last year. Now, given there are 5 members of the Trap Pack today, or Cinco, as they say in Spain, we'll keep this kind of tight and to the point, and one lesson each. I don't know who's going to start off because we didn't talk about it before we hit record. We don't talk about anything before we hit record. We just go with the flow. I'm going to pick on someone at random, and I'm going to go to a man who's been through the ringer a little bit recently, but is generally a real, just a positive person. Wodge, I'm going with you, mate, and gratitude is the attitude, which I love.
Okay, are you ready? So I'm going to go a bit deep. So what have I learned this year?
Should have got last, Nick.
Yeah, maybe.
Yeah, of course, Andy, because if it gone last, you should have been first. Please continue, Carl.
Okay. So yeah, I lost my dad a couple of weeks ago, and so I've had a period of reflection. It's been an emotional roller coaster, which I did share privately with you boys during the week. There's lots of things going on emotionally with me, and it's just reflecting, not because this was coming up, but in general terms, like we do all get very focused on, work goals or getting the next thing done, or I'll be happy when. And we've all said them, and we all say it, and we've all read this, and we all go, oh, yeah. But actually, I'm unbelievably grateful for the amazing relationship I had with my dad. I was very lucky. I know it's not the case for everybody. So I just keep reflecting on, there's so much really that I need to take a step back and go, do you know what? I'm actually so lucky for so many things. I've 4 amazing kids who have been amazing to me, and they all loved their granddad so much, and they were all amazing to me, even though they're grieving and mourning the fact that my dad he's 12 grandkids, and I guarantee you all 12 will say that they felt that they were the favorite because he was so involved with everyone. And his gift was the gift of time. So he gave everyone the gift of time. Clearly I don't take after him because I'm the most impatient person in the whole world. So that's a gift that hopefully will skip a generation, and maybe my kids will have it. But yeah, I just in general terms, then it's like, where we were born, right? To just call a spade a spade. Like we need to be so grateful for that, because you look around the world and it's like, holy crap, we are actually unbelievably lucky. At work, I'm unbelievably. We had our Christmas party last week, and I said it to them, and they're thinking he's only saying that because he kind of has to. But I said it to everyone at work. I'm so grateful for the work, for the energy, for the can-do attitude of the people around me, and we also have to be so grateful for being a little bit lucky sometimes. Like I to say that I would have set out to get to this moment in time in my personal and professional career, were all decisions I decided. We're all strategic decisions. Would be a load of old BS, because I got so lucky so many times along the way where, there was almost sliding doors moments where I could have made one call and I didn't for whatever reason. But I just think if we can all, well, look, I don't really care what anyone else does. I can just tell you my lessons and what I'm definitely bringing forward, and my emotions are still very high, guys. Right, you can probably tell that, right? It's all very recent, it's all very raw.
Sure.
But the next thing, the next target, the next physical, material thing, it means jack shit. I just wish my dad was around, So, and thankfully, I don't know who was smiling down on me, but in the few weeks before my dad passed away, I went down and I watched 3 rugby matches, 1 Ireland and 2 Munster matches with him, and Robbie was with me. My son was with me for one of those games, and that spending that time just shooting the breeze, that didn't cost any money. It didn't. We were watching it on TV because you couldn't go out, right, and stuff. Just spending quality time with the people that you love, and look, the amount of support that I've got from people wide and far, near and close, right? It's been absolutely phenomenal. And like, I'm very proud of my mom. She's absolutely heartbroken, but the way she's trying her best to, just keep going. And when she's so heartbroken is an inspiration to us all. My sisters have been absolutely incredible. All their kids. My partner Aoife has been unbelievably supportive of me. So when the chips are down, you'll see, you look around and you go, do you know what? Yeah, there's a lot of really great people in my life, and I'm so, so grateful for them. And, whether we, I don't know, get to 1 billion assets under management, right now, I couldn't give a shite. I really couldn't. There's way more important things. And I put in the Culture Corner the Baz Luhrmann song, because it's been going around in my head. I've been listening to it a lot. Everybody's free to wear sunscreen, but it's, the real problems are the one that blindside you on a Tuesday at 4 p.m. There's a line in the song that says that, right? And amazingly, I wasn't strong enough to say this, but when I got the call, I was sitting in a bar in London with Alan Smith, talking about how great my dad is. With mental, like, that happened.
Yeah.
And then I had the total shit show trying to get home, and it just wasn't good. But anyway, my lesson for myself is I'm going to be way more grateful for everything I have, and I'm not grateful for any of the things I have. I'm grateful for the people in my life.
Yeah. Wow. Okay, that was just lovely, Carl. Obviously, comes from a sad place, but someone's got to follow that. It's not going to be me. Who wants to go?
I'll go.
Brilliant, Carl. Brilliant.
I was going to say let our guests go, but you crack on.
It's all right, Alan. You carry on.
Give you more time to think. No, and you're right. Do you know what? It's kind of it's almost a cliche to say, have an attitude of gratitude and what have you, but it is so true. And even to the extent, it just reminded me, I used to write down little lists of things I'm grateful for, but it's not a habit that I gave up a while ago, but something that I should go back and do again. And you're right, Carl, I was with you sitting in that bar. I mean, that's absolutely true. It was an awful moment, but we were speaking about your dad. It was bizarre. Kind of continuing maybe on a slightly deeper theme. So the question came across, and of course we are always very, very well prepared for these sessions. Every time we do them, there's a flurry of WhatsApp messages about 10 o'clock yesterday. What should we talk about? What should we talk about? But obviously having a reflection of the year just gone past, and things we've thought about or reflected on, or lessons learned. So my one is, I'll just give the cut to the chase. The headline is "Get a Coach." Because for the first time in my life, properly, I've dabbled with coaches and what have you in the past, but I've been working with a personal / business coach for the last 3 months. Pretty solid, pretty deep, actually. We've had some very gritty conversations, and I reflect back on why I suddenly felt this was going to be valuable for me, and one of the answers is I don't know, but it just feels about right. I think one of the things was, and this can happen to, it might have happened to some of you on the call now. It might be something that we'll face in the future. But Nick, remember we had a conversation on this podcast a few episodes ago about you were showing up for client meetings and kind of doing same old every year, and you were considering, am I really adding value and all that? And I think this is part of my story. As you know, I'm off the tools in terms of day-to-day, face-to-face client advice. I'm still, actively involved with the business. I'm still helping win new prospects and business, but I wouldn't quite say I had a crisis of identity, but there was a certain amount of what am I supposed to be doing here? Another thing is interesting is once you've been, and we've all been in business for a while now, but we are a mature, we've been in business 21 years, and it's kind of it's a mature business, and it largely runs itself. I've got an outstanding team of people that do all the hard work. And I think just various thoughts swirling around in my mind about what does the next 1, 3, 5 years plus look like for me. And of course, I've got my own family and my kids who are growing up fast. My son will probably be off to uni next year and all those various things. And I just think this is quite intriguing because we give a lot to our clients. And sometimes, the conversations are often and usually way, way, way beyond the monetary side of things. And we do our best to give wise counsel and kind of, loosely life advice to clients, but we don't have, I haven't had anyone in my life giving me that. I can speak to you boys down the pub about stuff, but it's not the same. I can speak to my other half, but it's not the same. I can speak to my accountant, but it's not the same. But to have somebody who's kind of ruthlessly candid, asks me the tough questions that I don't really want to answer, but I'm prepared to because I'm paying money for it. And really, and as they say, the best coaches, all they do is ask you good questions and coax out the answer because you kind of know the answer deep inside you. But I've been working with this guy, Graham Godfrey, as I say, for the last 3 months, and there's been numerous 2 to 3 hour sessions face to face, number of Zoom calls to back that up. He's given me sort of homework, books to read, things to listen to, various sort of practices to go through. And I must say, I found it super helpful. I really have, in terms of just giving me clarity, I suppose. Like it is a bit of a first world problem. Like, what's my issue? My issue is maybe lacking a real crystal clear direction. 10 years ago in the business, I was crystal clear what I was doing. I was all about growing a business, hiring people, finding new clients, finding the latest technology, all that stuff. And now we're mature. I'm not saying we've given up, and we're still very ambitious as a business. But I guess my role, how I show up in life. And I think this is something for those of you who run businesses for a number of years, you might come across this. You might experience this in your life. So you look to the world of elite sport. You look to like the top CEOs of FTSE 100 companies. I don't know anyone who's really successful that hasn't hired a coach or numerous coaches, either in the past or usually on an ongoing basis. Because as they say, you can't see the inside of the jar. They can't see the label of the jar that you're inside of. If you know what I mean, you can't see yourself objectively. You think you can, but you can't see what's inside. You need an objective view from someone who knows you, understands you, cares about you, and is able to give you an objective view or opinion to allow you to do the work yourself, to come to the conclusions that you need to come to. So in conclusion, the takeaway that I have looking back on the year is get a coach. Invest in a coach, hire somebody good, and you might need to meet, as I have done, 2 or 3 to find someone that you resonate with, that you can be ruthlessly candid with. And as I say, I found it immensely helpful to me in the last few months since I've been working with Graham. That's my reflection of the year.
Very good. Pete or Ultra?
I guess first.
Okay, thanks, chaps. I feel your pain, Carl. I lost my mum in September. It's a freaking weird thing.
Sorry, Pete.
It's just the bizarrest thing I think I've ever gone through. And for me, the overwhelming... Thanks, man. No reason why you should. But do you know, the overwhelming thing for me in the weeks afterwards was complete and utter apathy. I couldn't put my mind to anything. It was just like, I feel like even though we had kind of 3 years notice in my case, because she was poorly for a very long time,
Yeah.
But anyway, actually, I also found that focusing on the things I was most grateful for, particularly about her, and then all the stuff that, she's put into me and all that was super helpful in sort of bringing me around as well. My lesson for the year, I agonized over this a little bit. To put it in a simple sentence, it's obviously not mine. There's a quote, something along the lines of, if you're not growing, you're dying, right? So if you're not moving forward in some way, then it's not just a case of you're staying where you are. But in the same way that inflation erodes the buying power of money over time, if you don't actually make it grow, same goes with our own sort of humanity, right? So obviously this applies from a business standpoint. We've had a bonkers year in Jackson's. It's basically the coming together of a whole load of work we've done over the last 2 or 3 years, as well as Meaningful Money gaining a kind of momentum, even in that I haven't actually produced that many videos relatively this year. The podcast has gone out as normal. But it's been a crazy year. We're 26% up in revenue in Jackson's. We are 45% up in profit. And when you're growing at that pace, which I don't think will continue quite at that pace, but you feel like you're clinging on to it, right? You feel like you're sort of grabbing on by your fingernails, and it's just like, I hope it doesn't sort of get away from me. And it's, if you're able to kind of grow a business at that pace, the problem, such as it is that you have to grow in other areas in order to keep up with it. And so you have to change the way you think about people. You have to change the way you think about culture and standards. I'm continuously saying to the team that as we grow, the two things that are most at risk are the culture, what makes us, and then the standards, the quality of what we do, right? And so these are the things that we need to guard. And I think, you can improve all that sort of stuff. And that's sort of fairly straightforward from a business point of view. If you're growing as a business, if the numbers are going up, you've got to grow in other areas too. And I think from a personal basis, my sort of reflection is that the same kind of holds true of our personal growth. The problem, I think, the thing that winds me up most about modern society is that nobody thinks anymore, right? They get spoon-fed their opinions in social media or the religion of choice or whatever, and they never question it, or far too few people do. And it's like we stopped growing up in our early 20s, many of us. We feel like we're growing up and we might change a little bit, but we never, I don't think it's common to actively pursue personal growth, particularly when it comes to our thoughts and beliefs and our understanding of things. And I just think we can, if we cling on to stuff that we've always known, but without ever challenging them, even if we challenge them and end up with the same beliefs as a result, they will be stronger as a result. So I still read stuff about active investing, and I've yet to read anything that changes my mind. But far better that than to just kind of parrot the same old line and never having read anything for 10 years, because it was true 10 years ago. Maybe it's still true now. I grew up in an evangelical Christian tradition, which in many ways its belief system was ridiculously backward. And yet my dad, who was a pastor in that whole system, actively chose, he's a scholar, he's one of the brightest men I've ever met, and he could have just kind of parroted the party line, and he didn't. He challenged it, and he's my sort of inspiration in that even at 85, he's reading stuff that he thinks he might not agree with in order to challenge his own position. I just think we don't do that.
Very good.
And so, I think it's important to have opinions. I think it's really important to hold them with an open hand, hold them lightly, prepared to be challenged. I just think it's a mark of a rounded human. I can't remember who it was that said, the mark of a keen intellect is the ability to hold two opposing views in your mind at the same time and not feel threatened by them. So for me, it's about growth, actively pursuing growth, both in beliefs, in understanding, in habits, in business, and all that sort of stuff, because otherwise I'm standing still. Worse still, if anything, I'm slowly dying. So if you're not growing, you're dying. That's my lesson for the year.
Love it. Jesus, this is about as profound as we've ever got. There's so much profundity on episode 86 that we've never had.
Don't worry, we've still got you to come, Nick, to bring us right down.
We'll bring it down.
Well done, Pete. That was lovely. And it's so true.
Thank you.
It's so true. And you never stop learning.
Critical thinking is in short supply. For sure.
Well, we don't teach it at school, do we?
No.
We just spoon feed our kids to be employees. Do you know what I mean? Jeez, yeah. It drives me absolutely mad, but I shall just step off the soapbox and move it to the side. Over to Andy.
But guys, just to say, like those two, like Alan, wildly successful with your firm, and saying, no, let's be fair here, guys, right? And to
He's
saying
just had
that
time on his hands. He's just made it.
Shush.
Andy, will you shut up for a
Yes.
second, right? To say that getting a coach has a profound change, right, is unbelievable. And then for Pete, who's hugely successful in your own right, also to say that we need to have this ability to change, because one of the things I'm finding in this world of social media and all that is that I'm right, I'm not changing. That's the end of it,
Yeah.
And it's very difficult to have proper discussions with people who are like that. Anyway. I applaud both those contributions. Well done, boys.
Yeah,
Thank you.
Ultra, do you want to go?
Yeah, I'll go next. That was absolutely superb. Yeah, Carl's point has hit home for me. Yeah, spending quality time with people you love the most. That's certainly something I've been trying to practice as much as I can. So yeah, this year has been, I suppose, a busy, tough year, like all years really. But it's been a good year. Kids are all good. Life's good. Business is good. I've had a laugh along the way and spent time with people that I love. My lesson for the year, just to have a point to mention in this race, is progress beats perfection. Basically, every single time, progress beats perfection. I've noticed the things that have moved the needle with me aren't the things that I've overthought or tried to endlessly polish. They were just things that I just started, showed up, and improved along the way. This perfection thing that we all sort of struggle with sometimes is quite seductive as such, having high standards, but usually it's just, fear dressed up really. Whereas progress on the other hand is a bit messy, a bit uncomfortable, but it's a lot more effective. And I'm also going to talk briefly about just showing up, showing up and doing what you said you're going to do. It might sound insanely obvious, but it's surprisingly rare. The world is quite average at the moment. So turning up, delivering, following through, I think builds momentum over time. And I've learned that consistency beats intensity. So just keep showing up, keep doing what you said you're going to be doing. The world is quite average at the moment. That's it. Over to you, Nicholas, to finish us up.
Yeah, great.
I just want to add a little bit to that. You said something which really struck a chord with me, just because I got recency bias, things that have happened. You said, and it's true, just continually show up, be consistent, and the world will reward you, but but you have to be patient. This thing about do what you say you're going to do, it's driving me freaking crackers right now. I've heard three situations in the last, you guys know some of them at least, of people saying, yeah, I'll do that. I'll send that across to you now, or whatever, any number of different things. And they don't deliver. And you think, and you're right, the bar to being successful has never been so low, because most people, and let's face it, most services that we experience, or I experience in, whether it's restaurants, hotels, most things, dealing with suppliers, dealing with utilities, and actually just dealing with some other people. People say, yeah, I'll sort that out now, leave it with me, and it doesn't get done. It's just, all you need, those things, say please, say thank you, show up on time, and do what you say you're going to do. Yeah. You do those four things consistently, you'll be ahead of 90% of your competitors.
Agreed.
It used to be called the referability habits, those, didn't they?
Yeah.
Back in the sales culture of the 90s.
Back in the day.
Yes, man. That's what true, though. Timeless truths.
Now, over to Nick for something deep, profound, and meaningful.
I know. I've set myself up here for an epic McFail. Just to echo some of the things said there. Andy, I love it. Yeah, perfection is the enemy of good. Carl, your thing about speaking about your dad the moment you found out, as you got the call saying he'd passed. My younger brother had a health scare recently, and it's brought us close together. Not that we were ever apart, but we were just typical boys, right? We never phoned each other or WhatsApp unless there was sport on, or we had some properly indecent photographs to exchange with each other, and that was it. But we've had more contact in the last few months because of his illness, and he seems to be okay. Thank God for that. Yeah, and it's just do it.
Glad to hear it.
Speak to them when they're here, man, because you can't when they're gone. You really can't. Gratitude. Yeah, everything you guys have said. Getting a coach, I'm not doing that. I saw a therapist once and she retired the next day. So bollocks to that. My thing is a bit shallow, and it is related to this thing of ours, right? So it's coming back to the reason we do this podcast, really. And that's our work is never done. That's the lesson I've learned. I seem to forget it every year. I think we all think to a degree that the world out there is moving to financial planning, and it's putting the plan before the portfolio, and it's talking to clients about their dreams and goals and aspirations. And maybe that change is happening, but my God, is it happening at a glacial pace? You know, the prospect that I spoke with this week, you know, in a cautious fund because mumbo jumbo questionnaire said so. No planning done whatsoever. That's 90% of what's going on out there. Maybe the amount of real financial planning, full fat financial planning has gone up, 3-4-fold in the last decade or so. There's still an enormous lot of it that's not done by people charging fees, ripping people off, putting people into shit products, and then somehow putting their pillow on the bed at night, like Bernie Madoff, and going to sleep and thinking the job's done. So for younger advisors, fear not. You'll be doing this for decades to come because our work is never done. Keep on doing the good stuff, people, and we will get there, but it's going to be bloody slow getting there. And that's my lesson from the last year. Okay, we are at 1 minute 20 more or less. So I think it's time, without further ado, to move on to Trappist Question. This is where we answer questions. There she goes. There's Posty. She's hauled the bulging sack up my drive. And this is where, Trappist, we answer a Trappist question. You can leave a question with us in the pinned tweet on X or the pinned X on tweet, however you want to do it, in the so-called show notes as well. The question this week, I haven't got a letter to open this week because this actually was sent to us in a Twitter conversation as opposed to a letter going to the hopper. And I thought I'd bring it forward and answer it today because it's kind of relevant to the budget and so forth. And this is a question on, I think, with somebody who's not in this thing of ours, Graham Compton, who's a systems engineer by trade, which means nothing to me, but I'll take your word on it. He's now retired from the day job. He's a part-time property investor. Well, our thoughts go out to you on that. He's on Twitter. I'll put his Twitter link in the so-called show notes. Here's Graham's question. The drop of VCT tax relief in the latest budget from 30 to 20% will have a disproportionate effect on the incentive for people to invest in small growth companies, which I thought was the prime objective of the last two budgets. These are high-risk investments, and it is quite common to pay up to 5% fees on both purchase and disposal of these illiquid investments. So is it now worth taking the risk on VCTs for an effective 10% tax relief for a high-risk, illiquid investment that you need to hold for a minimum of 5 years? I'll go quickly on this. I think the answer is no. I think it is dead now. I think it was dying on its knees really at 30% tax relief. If the incentive is now down to 20%, which it is going to be, I think it's dead and buried. I'm sure the VCT and the EIS people will tell me otherwise, but yeah. We've talked about these things before. This is a real example of the tax tail wagging the investment dog. It could almost make sense at 30% tax relief if you got lucky. 20% tax relief, yeah. Pete.
I love it. We get this on the podcast all the time. People answering their own questions in the question. So, is it now worth taking the risk for an effective 10% tax relief for a high-risk, illiquid investment that you need to hold for
High fees.
years? Yeah. It's I don't know. You tell me. Does it sound like it? No, I agree with you,
How's
Nick.
it stacking up at your end, yeah?
It's just like, yeah, you've answered the question. No, I agree with you. I think not. I've never really seen them work out well enough to justify the hassle or the risk or the grief and all that stuff.
Agreed.
I'm with you.
Just out of interest, a question for you boys. How many millions do you think this relief swallows up as in lost revenue for the government?
It's tiny.
Lost revenue. How many?
I don't know. It's tiny.
Tiny. I
What,
imagine
you're gonna
compared to
give us the
pension tax
answer?
relief or all the other reliefs.
Oh yeah, I've got the answer here. Yeah, just did a quick googling. Any idea?
100 million?
100 million, that's what I would say, yeah.
That's a good guess, lads. It's about 330 million.
Is that a good guess?
Wasn't that?
I would
Three times
I
out.
would have gone a little
Yeah,
higher.
I'd be glad if my
Yeah.
I would have
teachers
gone
would have taught me
higher
that
than
at school.
330.
The runway's 100 feet. You said 330 feet. It's actually not quite a good
That's
answer.
good enough. Yeah.
Oh, so you boys thought it was a real low number. What I'm saying is,
That is a low.
will
is, isn't
these will the companies produce more than that in the future? So they're giving up 330 million. Will these companies build into enormous companies that will pay loads of income tax, national insurance, VAT, corporation tax, etc., etc.? Like that's the trade-off. We're going to give you 330 on the tax relief, but we're going to make, a few billion in the future.
Well, it's another one of these, like the one that Pete alluded to earlier on, where it's contradictory. The government has said we're all about growth. They came into office on the back of a growth agenda,
And they're stifling growth
and they're trying to
further.
encourage investment in British companies and what have you. So there was this modest tax break, and you say highly illiquid, complex investments and what have you. Now they basically have, in my opinion, I don't think any of us have ever been fans of these, but they've just wiped it out, because I think the point that he's making as well, it's not just the tax rates going down, the tax reliefs, it's these are just naturally very expensive products to buy at the best of times. So that 5% spread going in, 5% going out, and I've seen over 3% a year in management costs once you sort of lift the lid and dig it. So as far as I'm concerned, they are dead in the water now. I still think there's a place for EIS investments. That's a whole other story. If you wanted to invest in a company, as we know, Ultra and I are serial angel investors. But if you had a particular company that you wanted to invest in, and you got a nice tax break going in and tax-free dividends and inheritance tax-free, but I think VCTs have gone now as a product. That'd be my opinion.
Yeah.
Okay.
All agree?
Yeah. Okay. Thank you, Graham. Right. Thank you for the question. Keep them coming. We've still got some questions to answer in the hopper, but do keep them in. And we will get round to your questions, even if sometimes they're a little bit contentious or pointed, as they have been recently at us. But we're big enough and enough to take it. Okay, let's move on. We're now, 184 minutes. Shoot me. Culture Corner. Yeah, channeling you.
It's my favourite of all the jingles, that one.
The tallest of the seven dwarves there.
Are we doing this in the order in the...
yeah, we are, sir.
Yeah, Nick goes quiet, so the first
person
speaks.
I see. I should know that, really. So I watched this in the bath as well. This was a 11
winkly.
And, well, that ship has sailed. So I keep putting weight on to kind of fill out the wrinkles. Thank you. So this was 11 minutes on YouTube video by the legend that is Daniel Priestley. He was just a rock star at Humans Under Management. He is one of my absolute favourite business minds.
Is he a close personal friend of yours?
I wish he was, but no, he's not. I do use his product. I don't think that counts.
Oh, do you use Score App? I'll speak to you about that.
Yeah, okay. So basically, this video is a complete 2026 social media blueprint, right? I don't really like the phrase social media. I don't think it applies anymore. But basically, a content marketing strategy. And it is, in 11 minutes, it is perfection. It's everything that I'm sort of doing and trying to do more of at Meaningful Money. How to move people from awareness into becoming an initial sort of making a step towards you and then becoming a client. It's probably the most, what Alex Hormozy, who's another, I'm also a fan of his, he would do in 2.5 hours. Daniel Priestley does in 11 minutes flat. It's absolute genius. Highly recommended.
Brilliant.
Excellent stuff. Okay, me next. This has nothing to do with this thing of ours, but it was a really good podcast. I know you guys like rugby, and you like kicky ball.
No.
This was, yeah. This is the rugby pod, which is Andy Good, the ex-England fly half, and Jim Harrison, the ex-Scottish lock. And they were guests, they kind of intermingled, because Ben Foster, who I think played for Hamilton in goal and played for Watford and various teams. He has his own podcast, and they were interviewing each other. Really good, frank, open discussion about just the differences between soccer and rugby, and the salaries, the whole culture and everything else, but done in a really nice way. And even if you're not a massive fan of either sport, it was just an interesting look into the business and looking under the bonnet of the business side of rugby and football, how it's similar, how it differs, how this concept of the agent in rugby has never really taken off. Whereas, of course, in football, if you want to go to the play, you have to now go through an agent really at the top level. Well worth listening. Well worth.
People take a look at me, right, and they say, "Oh, you must be into rugby," which I get a little bit offended by. But it's because I did half a term of rugby league when I was like 12 at school, and then went on the sick ever since. I could not stand it.
So is that yes or a no?
I don't understand it yet. Say again?
Is that a yes or a no?
I don't understand it. I don't get it. But I realise I'm in serious danger of being kicked out for saying that here.
I must admit, I don't understand the difference between the backs and the forwards. They're all interchangeable, aren't they? I don't get that, but that's more of an arcane thing. Okay.
The Renatus podcast, Greg Dilger is the host, and he interviews Steve Tennant, who's a Scottish guy who is the managing partner of Grant Thornton in Ireland. It's just a kind of the backstory of his career. He was tried to be a professional footballer in Aberdeen in his younger days, and the story about his career. I just love hearing people who are successful in their fields now, where they came from, all the kind of the nuances along the way. Grant Thornton's story is a little bit different in that they've sold in the States and now in Ireland to private equity, and what that means for a professional services firm at that level. It's a good story, good podcast. And the second thing I put in there was the aforementioned Baz Luhrmann, Everybody's Free to Wear Sunscreen. There's some great advice in that song, and
It's a great song.
I've been going back to it, and my poor kids are going to have to sit and watch it on YouTube over Christmas. So, kids, the odd time they listen to this, so now you're prepared.
Well, wasn't that a one-hit wonder? Does anyone know about that?
Yeah,
story?
it was a one-hit wonder. He's a
bloody
film
great
director
song.
who just came up with this, and which I used for a couple of years ago. A viral post on LinkedIn. It was took all that stuff, all the little advice, and transferred it to advice to a young financial planner. So anyone listening to this, I know Nick has saved it on his computer, probably printed it off, and checks it every day.
There is dishwasher instructions.
But yeah, it's good. It is good, solid advice, and I think, particularly Carl, when he says that, it's the thing. There's something that comes at you at 2:00 on a Tuesday afternoon. It's not the big thing you've been worried about. It's going to worry about. It's the thing you never, and that's the whole point of something coming out. So, Martin, the only one to give you a Christmas theme this year. Will you be quiet, Mr. Ultra? I'll give you credit where it's due. It's a bit late this year, but something that I recommend that people look into is buying an advent calendar for your other half. There's a number of these around. The one which is the best out there is the Liberty.
275 quid for a calendar. They can whistle.
It's the Liberty.
It's got £1,100 worth of stuff in it, Nick. It's a dream.
The bargain of the year, and it makes for a harmonious household in those chaotic days leading up to Christmas. So you buy the Liberty. There's a bunch of other ones out there. Liberty is the best. Is that right, Andrew? And you give it to your other half. And there is ones for the ladies tuning in, the female advisors, or
to buy for
people.
the men.
Then there's one for men as well. And you give it, and then they open it up every day like you do an advent calendar, and they get an interesting little gift every day, and it's fabulous, and it makes for a positive run-in
what
to
kind
the
of
festive
gifts
season.
are in it?
24. What 24?
No, it's 20.
Perfume, cream,
candles. Toiletries, but lots of interesting things that they would never thought about getting. And I do have to begrudgingly credit Andrew Hart, who's the one who put me onto it 3 years ago. And by the way, you do have to order it by about October.
Yeah, they're out.
Yeah, I ordered mine in October. Yeah.
What the hell is super renewal serum? That sounds dodgy.
When you're ordering next year, just remind me of that, please, Alan.
Yeah.
It is.
It's
the gift
it is
that keeps
spot
on giving.
Honestly, get it, order it. It is brilliant. Okay, you're last, Mr. Hart.
Yeah, to keep the Daniel Priestley loving going, this is his latest book, Lifestyle Business Playbook. I think it's brilliant. He is amazing. He is a practitioner, a business owner, doing exactly what he's telling other people to do. It's a brilliant book, Lifestyle Business Playbook. It's quite an easy read. Tells you the backstory about the industrial age, the education era, all the different stuff that's happening, and where we're heading. And the good news is you can run he says the perfect business size is between sort of 8 and 12 people. That's the sweet spot. And this modern age, with all the stuff that we can leverage, you can get some crazy revenue numbers and profits. And a lot of stuff we've spoken about in the past is all about enterprise businesses, the growing your business as big as you can get it. Whereas this one is a bit of a reversion, saying now with awesome technology, with a global team, you can build enormous businesses, quite lean. And the AI people are all saying at the moment, when is there going to be a business that's worth $1 billion will just have one employee? I think there's a few businesses worth a few $100 million with one employee, as in a sole person that's doing everything. So quite.
Is that you, Nick?
Interesting times.
Well, I was going to say, much as I like Daniel Priestley, he's wrong on this one. The perfect business size is between 1 and 1.
0 and 1.
Values division.
Right, okay.
Worth 1 billion.
We are at 93 minutes in. We're giving this a damn good thrashing. Episode 86 of the award-winning Real Advisor podcast. This is the last podcast we're doing before Christmas. So Wishing all of you, all of our beloved Trappists, a fantastic festive season and so forth. Want to thank Pete Matthew, the legend that's Pete Matthew, for being an honorary member of the Trap Pack
Thank you,
today.
Pete.
Great
Thanks,
stuff.
Pete.
Thanks for your contribution. Dear
The
Trappists,
Podfather.
episode, I knew you'd have to get it in. You couldn't help yourself, could you? Episode 86 comes to a close. Another pile of traps slides down the U-bend of Father Time. Trappists, be careful out there. Have a good session. Have a good season. Have a good seasonal period, whatever you want to call it. Don't kill the mother-in-law. Just eat the boiled sprouts, okay? Yes, she's murdered them yet again. Yes, the turkey's overcooked. Live with it. Get the spoon, those lumps in the gravy, flatten them out, and just suck it up, okay? You can have brandy afterwards, loads of it. Goodbye. Goodbye, people. Take care. We'll see you on the other side.
Happy
Merry
Christmas.
Christmas.
Merry Christmas. Oh, you paused it up.
No, it's just lagging.
Well done. First
Made it.
step in
Made
guest.
it.
Well done,
Full
mate.
guest.
Excellent.
Full guest. Yeah. Thanks, Pete.